IVM.
Folks, welcome to Paisa Vaisa. I'm your host Anupam Gupta, B50 on Twitter, and our guest today, Sachin Shah Fund Manager, Emkay Investment Managers, which is part of Emkay Global. Really thrilled to have Emkay with us. They are among the leaders in the Indian financial services sector, more than 25 years old. We're going to talk about what's happening in the stock market, what's happening in the PMS industry, and positioning your portfolio in this current environment right after this short break.
What is the workplace and how does your gender and body affect your right at work? Hey, I'm Priya Mirza, and on the Longest Constitution podcast, we critically examine the vision of the Indian Constitution and laws. In season 1, we looked at sex, gender, sexuality in India, and the landmark judgments which transformed our rights as citizens in this country. In season 2, we discussed the laws which shape the workplace and examine how ability, competence, and merit impact us, and much more. Join me, Priya Mirza, every Wednesday only on the IVM podcast app, website, and all the major podcast streaming platforms.
And welcome back. Sachin, welcome to Paisa Vaisa. Thank you so much for doing this for our listeners.
Thank you, Anupam. It's really a pleasure, and would like to share as much as we can today possible.
Look forward to that, Sachin. So let's start with a brief background on the Emkay Group as such, Emkay Global as it's called, what it does, and of course on the part that you represent, which is Emkay Investment Managers Limited.
Sure. So, MK Global Financial Services, right? It's more than a 25-year-old firm, founded by two first-generation entrepreneurs, Mr. Krishna Kumar Karwa and Mr. Prakash Kacholia, both of them chartered accountants. And they started this business as equity broking business. And of course, within the equity broking business, they focused more on the institutional equity broking, right? And, obviously, to get the institutional investors on your platform to transact, the value addition that MK as a firm offered was a very good insights on the research side, right? So equity research has been the backbone of MK as a group for more than 2.5 decades. And, and because our research has been very well, recognized, appreciated by the institutional investors, today MK is probably one of the top institutional broking house for the domestic institutional investors. I think our market share is closer to 4%. And as you know, maximum that's allowed mandatory is not beyond 5%. So we are among the top 10, top 15 brokers. Most of the insurance companies, a lot of foreign institutional investors, a lot of large banks, proprietary desks, they all do their transactions through MK's terminals. So today, MK has a very, very strong position on the institutional broking side. The backbone of this is, of course, the research. Now, because research has been the forte of MK, we, as a natural extension to a lot of other equity, other capital markets businesses, MK has spread out itself into other businesses, say be it commodities broking, be it forex broking, be it investment banking, be it MK Wealth, right? And then, of course, also MK Investment Managers, which is what I represent. And so MK Investment Managers is also more than a decade-old firm. We are a separate 100% subsidiary of MK Global. And MK Investment Managers is essentially the asset management arm of MK Global. So we are SEBI-registered portfolio managers, and we also have the AIF license now. So we manage discretionary and advisory assets for Indian equities for more than a decade now. And of course, we are a team of almost, MK Investment Managers is now a team of more than 15 to 18 people across fund management, research, business development, sales, operations, so on and so forth.
Sure.
So that is what, in a nutshell, MK Group is all about.
Okay, Sachin, let's talk about your clients. The HNIs, family offices that probably make the bulk of your client base. How have their flows held up so far in your products, in the PMS and AIF, especially in these last few months of volatility?
Right. So, actually, it's quite interesting that the investors have not shown any kind of nervousness or any kind of panic in the recent times also. So obviously the last 2 years markets were very good. But say the last 6 months, I think markets have been a bit jittery. In fact, we have also seen now decent amount of correction in stock prices across the board, right? At least 5 to 10% across, maybe a little more also in some of the pockets, right? But very interestingly, I think the investors have been very, very matured. Okay, at this point in time, is what I would like to think. In fact, if at all there have been any inquiries, they have been like, can we increase our allocation to equities? Taking the advantage of this weakness in the markets. So, one of the very interesting point that I'm actually observing for the last few years now, at least 3, 4, 5 years, and it's a structural thing to my mind, is that the investors are actually are far more matured compared to say what I used to interact with them say about a decade back or a decade and a half back, say 15 years back also. Because at that point in time, the investors' approach was very transactional, right? So when I say transactional, what I mean is like they are like, let's buy something, let's book some profits, and that is what they are looking at. Let us make some profits, right? But today, when I am interacting with most of my investors, and particularly the high net worth individuals, corporate clients, and I think even on the mutual fund side, if you see the way the SIP flows are, I think the whole approach is not so much transactional, but it is more of an as an asset class, right? So everybody is creating an asset class from equities, and they have a goal oriented to it. Somebody might have a retirement planning with that asset. Somebody might have a plan of say children's education after 15, 20 years. Somebody might have a plan to pass on this to the next generation. How do we make sure that the wealth that we have created is not doesn't lose its value due to inflation, right? So to keep up to that inflation, they want to invest into an asset class which will at least match the inflation or maybe marginally better. So the whole approach is now a very, very asset focused, asset oriented rather than a transaction based. And I think that's a paradigm shift to my mind when I see because these are changes which happen very small but on a regular basis, and then they are actually a big structural reform, right? So that is one thing that I have observed, that investors are no more panicking, as long as they believe that they want to create equity as an asset class as a part of their savings.
Very interesting. So when you say transactional, I'm assuming that what you mean is chasing returns. That what we used to see 10, 15, 20 years ago, that when the market is going up, people come in, and when the market is going down, they're not interested in talking at all, which is, I think, fairly normal. You're saying that there's probably a trend shift in that. You think this will sustain? You think that people are now actually recognizing that, the potential, I'm still saying potential because last 6 months have been weak for equities, but going forward over the longer term, do you think you're seeing your clients, probably even on a broader basis, retail investors believing in equities having the potential to beat inflation?
I think so, Anupam. And the reason is 2, 3, because see, most of the people who have been in equity since 2004, 5, 6, right? As long as they have stayed along, right? In spite of, say, 2008, 9, the global financial crisis. Then in 2011, 12, 13 also, we had some commodity challenges, right? If you see in the very recent times, we had demonetization, we had GST. I'm talking about the local factors. We had COVID, which is a global factor and also a local factor. In spite of all of this, right? If you have been an investor for more than 10 years, 12 years, 13 years, 14 years, and there have been multiple people like that. And it's not that only if you are beneficiary, but if you have benefited, you will talk to 10 other people and people look at it, right? Most of, have earned at least double digit return, right? And which is significantly higher than your bank fixed deposit rates, right? Just comparison and apple to apple in terms of if I would have put that money in a bank FD and if I would have stayed there for 7 years doing nothing, if I stay in equity doing nothing, I still have made about at least 50% to 100% extra over my bank FD, right? As they say, 1.5 to 2x is my risk premium over the risk free rate, right? So if that is what investors have already tasted that blood, right, have already experienced that extra returns because of they investing in equities and asset class. So the belief now in equities is there, and that's why, as I said, that and even the numbers are speaking. Like for example, in spite of the COVID, in spite of demon, in spite of GST, in spite of the last 6 months of weakness, the SIP flows are very steady.
Yeah,
right. SIP flows continue to be the 10,000 crore rupees a month, which is a very, very decent number to my mind today. 1,20,000 crore on an annual number. plus you have the insurance money which comes into the market. This is all I'm talking about domestic flows, right? Plus you have some part percentage of EPFOs and the PPF coming into the markets, right? So all of that put together is a good steady about almost 300,000 lakh crores plus number
Yeah.
annually basis coming into Indian equities, and this has been there for more than 5 years now. So the numbers speak itself that the maturity has come into play. And I believe that and also, the other important thing is that today, when people look around with their businesses, right, most of the businesses are actually very busy, right? Our exports have gone through the roof. GST collections are at one of the highest, right? So all these data points are very clearly suggesting that the domestic economy is very vibrant. So that feel good factor also gives confidence to investors that the domestic economy seems to be on a growth trajectory. We are into an up cycle. So I think, and I think the last but not the least, I think also very important, the alternate, right? The alternate avenues to invest are also very limited where you get double digit returns,
Hmm. Hmm.
right?
Fair
So
enough.
all of this has culminated where they are getting this maturity, I would like to say.
Sure. So before we go into the break, Sachin, I wanted to talk about this trend that I'm seeing in the high net worth side. Okay, where because now we are talking about equities, but within equities there's mutual funds and then there is what's called as direct equity. So for the HNIs, apparently there's a shift from exiting mutual funds and going into something like a PMS, something like an AF. AF, chalo, fir bhi, it's more of a evolved product, but as compared to PMS and a different taxation structure also. So what's your view on this trend?
No, Anupam, you're absolutely right. I think both PMS and even AIF, we are clearly seeing a trend where high net worth individuals, large family offices, okay? Because as we all know, that in the last 5-10 years, so many large business houses have actually got sold out, right? And so they would have encashed a lot of capital. In fact, a lot of these private equity investors are also kind of getting, selling some part of their stakes, and they're getting this money from the startups and all of that, right? So from all of this, yes, there is a decent amount of capital with large high net worth individuals, corporates, family offices across. In our interaction, again, we do echo what you're saying, that the trend is where they would like to go more bespoke, right? They want it to be much more customized. They want it to be much more personalized, right? Like just for example, today, a senior executive in an IT firm, okay, he has tons of ESOPs, right? And he has obviously capitalized on some of it, but still maybe 70% of his net worth is in ESOPs. The balance 30% could be a large amount which he needs to invest. Now when he wants to invest, he wants to make sure of one thing, that the balance 30% doesn't go into any IT companies, IT sector, because anyways he's 70% loaded into his net worth into one sector. So he wants to de-risk himself. Now, if he goes into a mutual fund, it's very difficult for him to get that diversification. But if he comes to a PMS, a customized PMS can be created for him where no allocation will be done to IT, right? Or like, for example, there are some large investors, it's an individual preference where they say that, as a family, we don't want to invest into any sinful business. What is sinful is their perception. That is every individual's perception, right? But they may decide that we don't want to be in a tobacco business. We don't want to be in alcohol beverages business, right? And there will be multiple of this. So again, that personalization or customization comes into this. So these are some of the factors. Over and above this, the other very interesting part is in terms of the risk profiling, right? Like for a high net worth individuals, you might say that I have already done my asset allocation quite well, right? Suppose if I have a few $100 million of assets, and if I already have 70-75% parked into the fixed income or a risk-free kind of asset, the balance 30%, I want to take a little bit of an extra concentrated kind of a portfolio. Now, in a typical mutual fund, you'll have 50-60 stocks at least, right? Whereas if he wants a concentrated portfolio, like say just 15 stocks or 12 stocks, or I want to take a concentrated bet in just 5 sectors, right? Those kind of bets are probably only possible under PMS structure and to some extent in the AIF structure, right? So again, for the return expectations that they would like it to be, right, the customization that they can get under PMS is also very important. The third part, which is also one of the very interesting points that we have come across, a lot of high net worth individuals feel that the kind of the returns that the mutual funds have delivered are not in sync with the fees that they have charged. right? So, for example, today most of the mutual funds will have a fixed management fee of anywhere between 1% to 2.5%, irrespective of the incomes, right? Irrespective of the returns that they would have delivered on that year, so because it's a fixed management fee concept. So here the investors feel that they have delivered on an average 10% compounded return. They have charged me 2%. What's the point? I mean, that's an individual perception. But on the PMS side, you can definitely again have a customized fee structure where you can link it to performance, where you can link it to a particular hurdle rate, you can link it to an outperformance of your fund to the benchmark, right? So all of these concepts are also very fast evolving within the PMS and the AIF structures. So because of some of these reasons, clearly the large HNI corporate family offices are really structuring a lot of their investments, keeping all of this into their profile and then investing.
Very interesting. So, folks, on that note, we're going to take a small break. When we come back, the real meat of this show, so to say, is Sachin's outlook on the stock markets, on the economy, inflation, interest, all of that on the other side of this break. Don't go anywhere.
Hello, hello. It's been another great week on the IVM Podcasts Network. On Cyrus Says Cock and Bull, Cyrus, Kajol, Abbas and Antariksh discuss how a Swiggy delivery agent rode a horse amid heavy rains to drop off an order. We're excited to present our new show, Do What Floats Your Boat with Danish Said in association with Boat. Danish talks to creators, influencers and notable personalities who pursued their passion against all odds. On the first episode, Danish talks to content creator Ruhi Dosani about how content creation became a part of her identity. Introducing our new show, The Ideas Project, powered by Small Case, a show to help you build a well-rounded investment portfolio. It's hosted by our very own Anupam Gupta. On the first episode, Anupam and veteran brand strategist Ambi Parmeswaran discuss the Tata Group and the investment opportunities they offer. On Paisa Vaisa, Anupam talks to Seema Prem, CEO and co-founder at FIA Global, about the essentiality of financial inclusion across economic strata. On Simplify, the Simplified gang discuss the right to repair movement. On All Things Policy, the Takshashila folk discuss sustainability with regards to policies that govern non-timber forest produce. And on the Life Manifesto, Zarina teaches us how to communicate effectively in our professional lives. Do not forget, IVM Podcast has just launched its merch and the first line is out now. Head to the IVM Podcast website, click on the shop tab to check out our first collection of t-shirts. Do follow us on social media. We are IVM Podcasts on Twitter, Facebook, Instagram and LinkedIn. And remember, if you're enjoying this show or any of our other shows for that matter, please do tell a friend. Also, don't forget to rate us on any platform you're listening to. You can also check us out on YouTube. We're also doing a small listener survey to better understand how you respond to our shows and advertising on the network. We would really appreciate it if you could spare a few minutes to fill it. It helps us build better shows for you. And finally, we would like to thank our sponsors this week: Boat Lifestyle, Small Case, Cap Gemini, Intel vPro, and Intel. Future Banao Wonderful with Intel-powered laptops.
And welcome back. Sachin, now let's get to some crystal ball gazing or whatever. Let's on your view. So I'm going to start with stock markets and then go to economy. But let's first start with what's been happening. When we're recording this, we are in the early part of June. May has just gotten over. I think it's a down month. Last, 6 months, the Nifty Sensex peaked somewhere in October. And since then, we've had this lull, ups and downs, severe ups and downs in the market. Going forward from here, what's your view?
Anupam, see, the important thing is that, I think the current weakness that we are seeing in the markets, okay, is clearly flowing from the global headlines and the global markets, okay? Because when we see the domestic economy, most of the demand indicators, suggest that a very, very vibrant activity, right, at the ground level. Like our exports, as I mentioned earlier, tax collections, both direct and indirect tax collections, all have been doing well, right? But, it is the challenges with the global supply chains, right? Due to the geopolitical conflicts and, the extended lockdowns that we have seen in some of the key places in China, which has actually strained the supply of commodities and which has kind of bumped up the prices, or maybe it's a bit transitory. But yes, at this point in time, we have to. It's very highly inflationary, right? The other challenge has also been with the US Fed and the other central bankers now actually panicking and pressing this interest rate button, right? So clearly, this was a global headline which created a knee-jerk reaction, across bonds, currencies, equities, commodities, spooking the global markets across, right? So, the important thing is that a positive change, either in this global headlines, either some positive news from from the geopolitical war side, or the supply chains, getting open up, right? All of that can actually bring back the confidence of the markets. Okay, because this is all global. This has nothing to do with domestic. Because when we look at the domestic side, I mean, we just got done with the March quarter results, which is the Q4, and the entire full year results also now we have in front of us for most of the companies. I think more than 90% companies would have declared their results by now, right? So we have a very fair understanding of how things have panned out. So most of the results have been very decent, right? Not only that, when you hear the management commentaries, right, they all are really fairly upbeat. They all are very optimistic for what they are seeing at the ground. Okay, but they all become very cautious when they also look at the global headlines. So what is happening is all hunky-dory. In fact, there was an analyst meet of Infosys just a couple of days back. And again, the management has been reiterating that all their customers across business verticals, across geographies, everybody is very upbeat in terms of their new businesses, right? Or giving them new orders, right? So, and similarly from across the other IT companies, if you talk to HDFC Bank, also had an analyst meet. Again, there the management was very upbeat about the uptick in terms of the credit growth, uptick in terms of the deposit mobilization, right? So obviously they all are doing something right. But the fact is, if there are serious headwinds, they will also have certain challenges, which at this point in time, none of them are feeling it. Right. So the point is that today it's only the global headlines which is making everyone cautiously optimistic. So everybody is optimistic when they look at their current numbers, but when they look at the global, everyone becomes cautious. Right. So once some of these global macros actually, once the war clouds are a bit away from us, once the supply chains are opened up fully, it's a more of a normal situation, and things will actually start cooling off. I mean, today we have also seen a lot of commodity prices actually already cooled off quite a bit. It's probably oil is the only last man standing, which is really still very high. And of course, that is one factor which really impacts the domestic economy the most. We have to be fairly conscious about that. So I think that is something what I think once that changes, okay, either the oil prices comes off quite significantly. If it is decisively below $100, say between $85, $90, I think the confidence will come back into the markets, right? And of course, we are also seeing some, like if you would know that rurals was some bit of a slowdown, the rural economy, right? There is some inflationary trends over there. But if these monsoons they are predicted to be fairly normal, and if it is really normal, because this will be the third or the fourth consecutive monsoon, which will be good. And generally, when that happens, rural economy tends to do very, very well. So I think it's a question of maybe a quarter or so.
Sure.
Most of this clouds will be out of our way, and the confidence will come back.
Sure. So just coming to the domestic economy now, let's forget whatever's happened in FY 2021, 22. Going forward from here, do you think we've got what it takes to sustain the 7-8% GDP growth? What's your view on the economy?
Well, as I said, when we look at the ground level, the economy is very, very vibrant. The activity is very, very vibrant. All the macro factors are also clearly indicating us whether it is the cement volumes, whether it is the steel volumes, right? Whether it is the power consumption, right? Both on the industrial and the domestic side, whether it is the consumption of the fuels, which tells you the kind of the business activity that is happening at the ground level, right? So if you look at the freight volumes, right? Both on the railway side and also the road side, the trucks freight, right? They all are very busy, right? So what I'm trying to say is that most of the macro indicators do suggest, right? Plus, the other very important part is for the other very big kicker that can come into the economy is the capex cycle, right? Today, what we are seeing is that many of the industries, and particularly within the many of the industries, the top players, the top 5, 7, 10 players, which have a 60, 70, 80% market share, are probably currently operating at probably 75% capacity utilizations, right? So it's just a question of time that they will have to start incurring capex. Now, once we get into the positive cycle of the capex, the virtuous cycle of capex, it again adds to your GDP growth significantly. Like today, if you talk to the textile guys, right? If they want a new plant machinery, if they want a new machinery for the weaving, spindles, or whatever, it is at least a 24 to 30 months waiting, right? So again,
Wow.
So from that perspective, I think the capex cycle is at the cusp of getting kicked in, right? And otherwise, also today, the way we are looking at is the overall manufacturing as a from in the country is actually going to do very well over the next 3 to 5 years. Whether it is the China plus one factor, because today many of the industries where India has proven its skills in terms of the precision engineering, or in terms of the quality side, or in terms of the scale. So whether it is textiles, whether it is auto ancillaries, whether it is specialty chemicals, whether it is pharma, whether it is IT, all of these industries, wherever we have seen that Indian industry has actually delivered, right, quality and scale, the global customers are really looking to de-risk themselves from countries like China, and to convert to source some bit of their requirements from India. Now that again is going to really help in terms of driving our GDP growth. Today, exports are already at $420 billion, which is like, I think after 5, 6, 7 years, many years, I am seeing that we have a high double-digit growth, and it seems like it's going to sustain from here on also. So, all these factors clearly suggest that probably we are into a multi-year high growth era, at least for next 3 to 4 years.
Got it. So let's wind up this episode now, Sachin, with a bit of discussion. See, I mean, inflation and interest rates are linked. And I think where we are right now, probably the market is factoring in about 100 to 150 bips of rate hikes coming in India for the rest of this year, hopefully, out of which 40 bips is already done in the previous policy meet that actually it was an out of policy meet where we had the interest rate side. So let's talk about sectors and how you're positioned in them. Which ones do you like? Which ones do you want to avoid in this era of rising inflation, or rather, let's assume that it's stable inflation and interest rates?
Right. When we look at the demand side, right? When we look at the balance sheet of some of the sectors, when we look at the valuations of some of the sectors, I think at this point in time, markets are very interestingly poised, because, when I see each of the sectors, okay, some of the key sectors rather, say banking, say autos, say IT, say pharma, right? These 4, 5 sectors are probably maybe 70-75% weight of the entire Nifty. Okay, because banking is almost 35-40%, IT is another 15%, pharma is another 7-8%, auto is another 6-7%, right? So all of this put together is closer to about 70-75% kind of weight across the board, right? Now, if you look at each of the leaders in each of these sectors, right? So banking, you will have, say, within the private sector banking, you'll have HDFC Bank and ICICI Bank, right? In IT, if you have Infosys of the world, right? Say within pharma, you will have companies like, say, Divi's and Sun Pharma, right? In autos, you will have companies like, say, Maruti, or say Eicher Motors within the two-wheelers, and those kind of. So each of the leaders in each of these sectors today, if you look at their balance sheets, okay, they are very, very strong, right? Second, if you look at the kind of demand outlook commentary that the managements have given us, they all again look very, very strong, right? And then third, if you look at the valuations, right, all of them have corrected quite a bit in the recent times. Because of obviously the technical reasons is what I would like to believe, because of the large FII selling that we've seen over this period. And
sure,
FIIs have a very significant holding in some of these businesses. So today the valuations of a lot of these companies have become very, very reasonable. So to my mind, that some of these leaders in each of these sectors today offer a very, very decent investment opportunity.
Great. So if I've got you right, you said you were looking at banking, looking at IT, looking at pharma, looking at autos. If I've broadly understood you
Absolutely
right
right.
on that.
Yes.
Great. And within them, the larger cap or the market leaders, as you say, seem to be reasonably well positioned.
Absolutely right. Yes.
Fantastic, folks. So there you go. Economic growth expected to sustain going forward. Global factors should hopefully cool things off, maybe in a few quarters, maybe more than that, we don't know. And then hopefully the resumption in the stock market should continue. Sachin, does that summarize our discussion so far?
Sure. Thank you.
Great. So, folks, with that, that's a wrap on this episode of Paisa Vaisa. My guest, Sachin Shah, Fund Manager, Emkay Investment Managers, part of Emkay Global. Sachin, thank you. Really, thank you so much for doing this for our listeners.
Thank you. Thank you very much.
And listeners, thank you for listening to this episode of Paisa Vaisa. If you like this podcast, don't forget to check out other interesting podcasts on the IVM network. You can listen to us on the IVM Podcast app or ivmpodcast.com. You can also follow us on our social media. We are IVM Podcast on Twitter and Instagram. And if you want to reach out to me, I'm your host, Anupam Gupta, B50 on Twitter. And thank you so much, folks, for listening to Paisa Vaisa.
No material on the show should be considered as financial advice. The material on the show is for informational purposes only. Please consult a financial advisor before taking any investment decision.
Have you ever wondered where the business world is headed? How the ways in which we create, market, and sell to consumers will evolve? Or if we'll ever go back to wearing pants while working? For answers to all of this and more, tune into Advertising is Dead with me, Varun Tugirala. Every Tuesday, as I talk to entrepreneurs, leaders, and change makers from across business, media, marketing, and beyond. You can catch all episodes of Advertising is Dead on the IVM Podcast website, app, or wherever you get your podcast from.
There's a quick survey to fill out on ivmpodcast.com/survey. It lets us know a little bit more about who's listening to us. And you know what? We're going to do a few prizes. So, we'll do a random drawing of maybe 10 people and we'll send you all some swag. Remember, that's ivmpodcast.com/survey where you can fill out the survey.